Hey guys, what's up? I'm Erin and welcome back to the channel. If you're heading into retirement or already there, one of the most important questions you might ask yourself is this: how much cash should you actually have on hand? I'm not talking about your full retirement portfolio. I'm talking about cash that's on hand and easily accessible, money that you can tap into without having to sell things off or shuffle things around. And the answer might surprise you because financial professionals tend to recommend that retirees have anywhere from 1 to 5 years of essential expenses on hand and at the ready. And that may sound like a lot, and it is, but there's reasons why this approach is so widely endorsed. The major investment brokerage houses all emphasize the importance of healthy cash reserves when you go into retirement. Fidelity and T. Rowe Price often suggest a minimum of 6 to 12 months. Vanguard highlights cash as a way to weather market volatility without touching your investments. But here's the thing, when we talk about 1 to 5 years worth of expenses, we're not talking about your entire budget. We need to look at the gap between your guaranteed income streams and your essential expenses. So if you have guaranteed income streams like Social Security, an annuity, or maybe a pension, this is going to reduce how much you need in your cash reserves accordingly. Let's walk through what that looks like in real life. Let's say you're a retiree with $4,000 a month in essential expenses. Things like housing, food, medical bills. And then you receive $1,900 a month in Social Security benefits. That means your actual monthly shortfall is $2,100. So for a 1-year cash buffer, you'd need about $25,200 sitting at the ready. For 3 years, that becomes a little bit over $75,000. And for 5 years, you're looking at $126,000 in cash-like reserves. Now let's consider a married couple who has this same $4,000 in essential monthly expenses. We'll say one spouse receives this $1,900 in Social Security benefits, and we'll say that the other spouse was a stay-at-home partner, so they receive 50% of the first spouse's benefits, so $950. Together, they receive $2,850 a month from Social Security, which means their monthly shortfall is $1,150. So for a 1-year cash buffer, they would need $13,800. For a 3-year cash buffer, a little bit over $41,000. And for a 5-year cash buffer, $69,000. So again, you're not funding your entire lifestyle with cash, just the gap. So why go through all of this? Let's talk about the real benefits of holding a meaningful cash buffer. Market downturn protection is a big one. You've been watching the markets lately. You know there is plenty of volatility. And for those who've just retired or they're just on the brink of retirement, this can cause a lot of stress. You might start to question, did I really choose the best time to step away from the workforce? Well, the good news is if you have a solid cash buffer, this really shouldn't rattle you. You already have what you need to cover all of your essential expenses, and you're not forced to sell your stocks at a loss. You can wait for the market to rebound. There's another big reason this matters: sequence of returns risk. This is the idea that the timing of market returns can dramatically impact your portfolio once you're withdrawing on your portfolio, especially early on in retirement. So let's do an example to see what I mean. Let's say we have 2 investors, Doug and Calvin, and they each retire with a $1 million portfolio. They both plan to withdraw $45,000 annually and increase their withdrawals by 3% a year, adjusting for inflation. Doug experiences great market returns early on. Doug's portfolio experiences growth early on. This allows him to build a buffer and gives him a cushion, and he can successfully make all of his necessary withdrawals for 40 plus years. His portfolio lasts the length of his entire retirement. Now let's say that Calvin experienced the exact same average return over time, and the only difference is those first 4 years of returns. We're going to reverse the order of them. Let's see how that affects his portfolio. That early negative return hits hard, and because Calvin is making withdrawals during a down market, his portfolio doesn't get a chance to recover. His portfolio would run out of money in 25 years, and that is a really bad situation to be in if you outlive your portfolio. So it's the same withdrawal, same average return, but ultimately a very different outcome just because of timing. To protect against a situation like this, you can build a cash reserve to avoid selling during downturns. You can use a bucket strategy, which I'll go over in a moment, and you can diversify your portfolio so you're not relying too too heavily on stocks during early retirement. And finally, there's an emotional side to this. Just knowing that your next 1, 2, or 5 years are completely covered, that should bring you really strong peace of mind. That should allow you to stay the course with your investments and ride out these ups and downs in the market without panicking. Now, of course, there are some trade-offs to keeping a lot of cash on hand. First up is the opportunity cost. When you hold a big chunk of your portfolio in cash, you're giving up the chance for growth. Between 1997 and 2023, cash investments underperformed the stock market by about 8% per year on average. Over the course of 20 years, that kind of gap can really add up, and that could mean falling short of your long-term goals. So yes, while cash is safe, there is a cost to sitting on the sidelines. The second is inflation risk. Cash loses value over time if it's not earning enough to outpace inflation. And if we assume that inflation happens at a rate of, say, 3% per year, in just 24 years' time, your purchasing power would be cut in half. So yes, there is a cost to sitting on the sidelines. Next, you need to have a replenishment strategy. When you dip into your cash buffer, you need to have a plan to refill it. And one of the best ways to do this is to take from your investments when they're doing well. You pull off some of those gains and you refill your cash bucket. That way you're not left selling your investments when they're down. And finally, remember it's a balancing act. Cash reserves gives you peace of mind, but too much in cash will really drag down your portfolio's growth. The key is striking a balance between safety and long-term growth. So you just want to make sure to revisit your portfolio on a regular basis and make sure that you're preserving long-term growth while making sure your immediate future is safe. So how do you actually determine the right cash buffer for you? You want to look at your monthly income gap, your expenses minus any guaranteed income streams like Social Security, a pension, or annuities. Then you want to multiply that by however many years you want a cash buffer to cover. Let's look at what that would look like with a bucket strategy. Using the previous numbers, with essential expenses at $4,000 a month and an individual getting $1,900 a month from Social Security, that means your shortfall is $2,100 per month. Let's say you want your short-term bucket to cover 3 years worth of expenses. So that would be $75,600. Now let's move on to bucket 2. This is for your intermediate term needs, covering anywhere from, say, 4 to 10 years in retirement. You still have this same $2,100 per month as an income gap, and you'll want to fund that for about 7 years. So you'd need about $176,400 for bucket 2. Now, this bucket shouldn't be in cash, but you don't want it in volatile investments like equities. Maybe you want intermediate term bonds or CDs, something that's going to give you more of a return, but not as low of a return as cash, and it's not as volatile as the stock market. And finally, we have bucket 3. This is for year 11 and beyond. And there's really no fixed amount that you want here. You want to have buckets 1 and 2 full, and any remainder or surplus goes into this long-term bucket. And this bucket is really important because this is the bucket that fights inflation and provides long-term growth, knowing that your portfolio will be there long-term. This might be stocks or index funds, ETFs, REITs, anything that allows your portfolio to grow and help you to replenish those other buckets so you have money now and in the future. This structure is great for managing risk, especially sequence of returns risk, because it prevents you from having to sell any of your equities in a down market. And the last step is to regularly review and adjust your plan. You want to refill bucket 1 from buckets 2 and 3, especially in those good market years, and you do want to make sure that you're looking at your portfolio at least once a year. I know many of you who are watching this video will look way more than that, but look at least once a year, make sure your portfolio still fits your needs, and make sure to look at it anytime you have some big life changes. I do have entire videos on the 3 bucket strategy and exactly how to refill those buckets over time, and I will link them down below and above if you're interested in the full breakdown. And just a quick note on equity exposure. Even in retirement, most experts still recommend having a strong exposure to equities, perhaps 40 to 60% of your portfolio in stocks. That might feel aggressive, but it's essential to making sure that you have money in the future, that your money has the power to grow and beat inflation over time, because having too much in cash really risks the longevity of your portfolio. You run the very real risk of running out of money. Take the classic 60-40 split portfolio, where you have 60% in stocks and 40% in bonds. Historically, this portfolio has performed very well, and when markets are volatile, even in recent history, this portfolio has performed much better than the broader market indices. Now, perhaps you want more in equities when you're in retirement, or maybe you want less. That's a personal decision, and it depends on a couple factors. It depends on your comfort with risk, your time horizon, any other income sources you may have, Social Security, a pension, and it depends on what's happening with the markets. And of course, you want to pair your equity exposure with smart diversification, regular rebalancing, and yes, a strong cash buffer. That way you are prepared for no matter what the market throws at you. Retirement isn't static. The markets shift, expenses change, and life throws you curveballs. You want to make it a habit to check your buckets and to check your cash buffer regularly over time for when these inevitable changes do happen. What are your thoughts on your emergency reserves or your cash reserves as you go into retirement? Share them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Did you hear my watch? That's so frustrating. Okay. I didn't mean to do that. I meant to mute this. I'm causing more noise and causing more of a problem. Everybody, shh, all the electronics. I don't need to hear from you right now. Your long-term goals. Who's calling me? Okay, I have to take it.